Securing a business loan can be one of the most daunting challenges for small business owners, especially when faced with strict lender requirements and overwhelming application processes. It becomes even more frustrating when financial institutions turn down your application, leaving you unsure of how to improve your chances. The solution lies in understanding the key steps to enhance your application and navigate lender expectations with confidence. In this video you will learn how to get approved for a business loan. Step 1. Assess your business creditworthiness. One of the first things lenders scrutinize is your business's creditworthiness. Begin by checking your personal and business credit scores through major credit bureaus. A low credit score can signal high risk to lenders, leading to either high interest rates or outright rejection. Pay down existing debts to improve your credit score. Address any errors on your credit report and avoid making large, unnecessary purchases leading up to the application. This will show lenders that you have strong financial management skills and can be trusted with their loan. Step 2. Understand lender expectations and requirements. Different lenders have varying expectations when evaluating loan applications. Banks may require excellent credit and detailed financial statements, while online lenders might prioritize cash flow over credit scores. Research each lender's specific requirements before applying. Reach out to loan officers to understand their expectations, especially concerning minimum credit scores, business revenue, and collateral requirements. This proactive approach helps align your application with what lenders are specifically looking for. Step 3. Gather and organize essential documents. Missing documents can delay or derail your loan application process. Lenders typically request personal identification, business financials, tax returns, and legal documents proving the business's legitimacy. Organize all necessary paperwork in advance to avoid delays. Common documents include 1. Personal identification, a driver's license or passport. 2. Business financials, profit and loss statements and balance sheets. 3. Business tax returns for the past 2 years. 4. Articles of incorporation or business licenses. Having these documents ready demonstrates your business's credibility and helps lenders make faster decisions. Step 4. Create a comprehensive business plan. Your business plan tells the lender why your business deserves funding and how you'll repay the loan. It should include an executive summary, market analysis, and detailed financial projections. Develop a business plan that clearly outlines your business strategy, target market, competitive advantage, and how the loan will contribute to growth. Include cash flow projections that show the ability to handle debt repayment. A well-thought-out plan increases lender confidence in your business. Step 5. Improve your debt-to-income ratio. Lenders prefer to see a low debt-to-income ratio, which indicates that your business can comfortably handle additional debt. A high ratio may suggest over-leverage and impact your ability to secure the loan. Reduce outstanding debts before applying for a loan. Review existing loans. Negotiate better terms where possible and prioritize paying down high-interest debt to reduce the ratio. This will free up more of your revenue for loan repayment. Step 6. Consider different loan types. Not all loans are created equal, and choosing the right one depends on your specific needs. Traditional bank loans, SBA loans, and alternative financing options each have unique terms and requirements. Determine your financing needs to match the appropriate loan type. For instance, SBA loans are great for long-term investments, while lines of credit are perfect for managing seasonal cash flow. Understanding each option's pros and cons ensure that you apply for a loan that's tailored to your business. Step 7. Research and choose the right lender. Each lender has unique criteria, so choosing the right one is critical for increasing your approval chances. Some are more flexible with startups, while others prefer businesses with a strong history. Explore various lenders, from traditional banks to online platforms. Compare interest rates, repayment terms, and loan conditions. Consider reading reviews or asking fellow entrepreneurs entrepreneurs for recommendations. This research ensures that you don't waste time applying to lenders who are less likely to approve your application. Step 8. Follow up and stay prepared. Even after submitting your application, follow-up can make a big difference. Lenders may have additional questions or request extra documents. Stay proactive by following up with your loan officer to check the status of your application. Be ready to provide any additional information promptly. This professionalism leaves a positive impression on lenders, signaling your commitment and reliability.